Stream. Boom. Good.
Welcome, everyone, to Name Confidential Live.
Hey, everyone. Welcome to Name Confidential. I'm this week's host, Ryan Redfern, and today we have Sam Jurrens, the CFA and CFP from Even Heard, and he's also the manager of the Even Heard Long Short ETF. Sam, awesome to see you. Good to have you here today.
Thanks for having me.
Nice, nice. Well, let's we always start off jumping into the name exposure next. I'm going to flip over to that real quick and take a look. I don't believe you are a contributor. Do you follow it at all, or just know it exists?
I do. I do some. I know I'm aware of its calculations, so especially
Gotcha.
from
Awesome. So
last
this,
conference.
yeah, right. So this week we are at 68. No surprise with some events going on in the world with the price of oil. Market's been selling off. So yeah, that's pretty good. Pretty low there. I know historically, can't think of his name. Rob Hanna of Quantifiable Edges has a good study showing when this pulls back below 60, it's often a good buying opportunity. So maybe that's what we had last week. I don't know. We'll have to see. But yeah, I reported up in the hundreds because I was like, I think we're gonna come back. But I can also post 200, so that's moderate for me. And it's interesting that some people were negative 100, and some people were still positive 200 this past week. So that's kind of wild. But all right, let's get back to Sam though. So I got to ask Sam. I think how did you come up with the name Even Heard for your fund and your company? I think that's I've heard it pronounced miscorrectly quite a bit. So.
By many. So yes, it is even herd. So kind of thinking of looking at herd as the market, market participants, broad group of people, but even being even kill, trying to be statistical or level-headed when looking at it. It was actually AI was my sounding board for
Yes.
picking the name, kind of going through multiple lists of something short as well, and evenherd.com is also available, which helps. So,
It's also a plus.
yeah.
Nice, nice. Well, let's kick it off with kind of your background. How did you get into finance? Is this what you always wanted to do? How did you get to become a fund manager from wherever you started?
Yeah, absolutely. I grew up in a finance family. My dad was a financial advisor. He previously worked for a company then EF Hutton, which was a massive firm at that time. He left in the 80s, started his own, RIA practice. So I kind of grew up around it, worked part-time through, middle school, high school at his office, filing papers, those kinds of things. Beyond that, did international business and finance in school, and have always been real interested in really value investing was my initial, love and my the first part of my career. Ended up getting into investment management, managed a hedge fund with a business partner as well that was really focused on that value space. It was a lot more arbitrage, kind of micro cap focused, where, as more time passed, the more I understood, there's more than this in the markets that aren't explainable, especially in the real public space, the larger part of trading activity. So.
Like it. So you were a value investor, CFA. Where'd the CFA come in there? Because I know you're now doing something that's really kind of the opposite in some ways.
Yeah, yeah. So I I worked for a municipal bond brokerage firm through college as well, and my manager at the time, he had this whole stack of books next to him that he was studying when I was working at the internship, and I asked him, "What is this? Tell me about it." And he just told me that's what you need to study for and take it versus MBA or something like that. And
Right.
so from there, it was, when I was in school, I started studying for it. And then after school, got the work experience and was able to have the credential. So
Right, right. But I think this segues into your investment philosophy. I mean, how has that shifted now that you're a little more quant, a little more AI focused?
absolutely. So, through the value career, I was also, really around technology even as a child, programming, things like that, graphic design. And I built an algorithm well over a decade ago now. But it's still at that time, it wasn't something I really paid much attention to. I was still blinded by, my other bias. But over time, I got to watch how many things it would have protected me from, how many how many decisions it made that were so much better than what I could have ever forecasted or projected, that it got to the point that when you look at diversified portfolio management, holding a ton of positions, that's a difficult job, especially in a value world. You've got to overweight your strongest convictions. And for me, having a tool that I can stay massively diversified, as well as something that's more systematic, that's not as biased, it just became it just felt to be the right fit. And that's kind of where the ETF came from. Was it's a little bit more active, so our turnover is a little bit higher. So running a SMA is a little bit more difficult versus something like an ETF that we can wrap it in a tax efficient vehicle. And so that's where ETF just made sense. Looking at the space, there's not, many long short managers as well. When you contrast that in the hedge fund side, most of them 150/50 type structure, very levered. We're actually not leveraging that cash. We're trying to stay, we use 100%, we leave the cash there and short through that. And we can go, plus, 10 to 90% is kind of the range that we can work within. And so we're not really using leverage outside of, the inherent shorting ability.
Right. And I think you said something interesting about, your high conviction on your best ideas. Does AI change how you approach that? I mean, you may have best ideas based on your analysis, but does the AI come up with things that you would have never thought of, or even does it contradict?
Yeah, in full disclosure, I would say our usage of AI is increasing almost every day. But in terms of the system itself, it's a lot more algorithmic in nature than necessarily AI based.
Okay.
I think the way we're using AI is more in research, finding things or understanding things quickly, to at a high level, to then be able to figure out where to dig in deeper.
Right, right. And to be fair, I think everybody says AI kind of, and they mean like large language or using computers to do analysis for you.
Yeah,
So I think
absolutely. Yeah,
that's,
like machine learning related. Yes,
yeah,
absolutely.
yeah, exactly. So AI is not necessarily it's thinking for you, but it's just heavy lifting and
Yeah.
thinking,
Yeah. Which I'll,
taking your
I'll
time.
kind of discuss some of that too in the fund of, the roadmap ahead. And I think, I mean, not just the ETF or my business, but every business in general is going to be, very heavily involved in AI, whether they want to or not.
Oh, absolutely, absolutely. So yeah, so let's transition into your investment philosophy and your process a bit.
Yeah, absolutely. So, do you want me to go ahead and share my screen
Yeah,
so
if
that?
that's a good way to segment it. I think you said you're gonna kind of combine your philosophy and then how you use active management. So if that
Yeah,
works,
yeah.
let's go that way.
If you look at some of our information that we have too, we discuss a lot of relative momentum in
Mhm.
our strategy. For the algorithm, momentum is not necessarily exactly what it is, but it's, if you look at our fund and compare it in a factor basis, momentum is going to be the most correlation to our strategy. And so we do look at momentum as something that can kind of define a lot of our
Mhm.
strategy, or I would say maybe bias even. But it reverse that with value. I feel like momentum is a bias of saying you like to buy things that go up, and I think I can sleep well at night with that, for sure. But it poses difficulties, because if we're shorting, and if you're technically shorting anti-momentum and
Mhm.
long momentum, there's a lot of complications and issues in that type of philosophy. But I would say relative is the best way to define how I look at markets, how I look at life. Everything is relative. There's not
Yeah,
anything that's absolute, in my opinion.
right.
It's all relative. And
Yep.
so why don't we look at the markets that way? If something's going down 10%, you don't know if that's good or bad. If you just hear it's down 10%, when you find out everything else cratered 90%, so
Yeah,
down 10% is pretty good. So that's
exactly.
really how we approach the markets, and try to continue to look at some kind of level for the markets.
Perfect. Perfect.
Yep.
Yeah, I was going to ask about the contrast between value and investing in momentum. So I'm glad you touched on that.
Well, and it is one of the things, in academia, if you look at the most inversely correlated factor to momentum is value. So you would
Fantastic.
think, oh, it's a good supplement, but I I disagree because to me it's coincidental. You know, if you look at value, the reason why value is inversely correlated is because value is what is has done poorly. You know, that's why it's cheap. You know, the valuations are low. And then you look at momentum. Well, yes, it's typically more growth, higher valued assets because they went up in price relative to the relative to the valuation in the past. And so when you look back in history, that's to me more coincidental than, you know, actually having any relationship within each other. It's just simply one price went up, went down, and so they have that mean reversion characteristic in a way. So, but that's I think a good, you know, this I wanted to show
Yeah.
something we talk about a lot in that relative basis. You know, if you want to think of the way we see the markets, I think an ocean is somewhat relevant to describe it. You know, in the ocean, you know, you have storms, you have waves, you have all sorts of things happening, but at the end of the day, you have a sea level, right? And so for us, we're trying to find out, you know, what waves are building and what waves are crashing. You know, we want to be investing and working with the stocks that are building and then trying to short and find the stocks that are crashing in a diversified manner. And so this is one example. We have many ways to kind of slice this, but you know, we write about this in our blog updates sometimes that we call it the sea level. For lack of a better term, but you know, if you want to think of this left-hand side of the chart, that looking from 1 to 4,000 would be maybe a universe of 4,000 stocks. So this sea level would be, okay, what stocks are above or below that line? And so
Gotcha.
charting this out, you can see I wanted to show kind of 2021 and 2022 because that was such an extreme
Right.
market environment. You can see how low the sea level got. So it was very hard to find stocks that were
Mhm.
actually going down. Almost everything was going up. And so when you look at the sea level, it actually bottomed out there and started rising significantly for, you know, a good 6, 7, 8 months prior to the market peak. So for some of your members or viewers, you know, a breadth indicator in a way is the way you can
Sure.
kind of look at this. And so the market's rising that much prior to an actual, you know, peak in the sea level. We see something that we would want to begin to add shorts. So
Mhm.
sea levels rising, we're more, you know, we see more caution, more excuse to add shorts, more shorts are available. So if we're looking at stocks that are crashing, or in a sense of going below sea level underwater, we're going to have a lot more opportunities to short. So, and so we're able to add shorts to that. And that's kind of what protects you. You know, this kind of indicator is better for, you know, real trends, you know, and what we've been having to deal with lately of, you know, markets falling and rising so fast in 2 weeks.
Yeah.
That's not, you know, that's not as helpful for something like this. You know, especially what I think the tariff tantrum uh,
Mhm.
period. You know, you had
Right.
the
Right.
largest collapse in history, followed by the largest recovery in percentage terms in history. You know, as quick as it was, and so
Right.
that you know you can get whipsawed, but you know that's happening to the sea level, and so.
Mm.
So we use this among you know other things to kind of look at what's happening in the markets right now.
Nice.
And so internally, if we break it down to say, okay, let's look at a individual position, an individual stock, this would be Palantir. So this is a last 5 year view of Palantir within our system. And so if we take, you know, if you're in the top 1,000, you know, you're calling top 25% of the market. So we can see where it hit top 25%, even going up into the top 10%. So those are kind of those lines marking that on the chart compared to it falling out of the top 10% and then falling out of the top 25% of the market. Now, if you squint your eyes a little bit, this is what I tried to help visualize for you within that stock. So you can see the stock price overlaid in Palantir versus our system. And you
Oh,
can see, you know,
okay.
this the right axis we had to do log pricing because the price was
Mhm.
so crazy over that period. But you know, you saw it hit that region, you know, call it around $15 a share. And then And if you look in our system, it's fairly stable, throughout that. So we're not really having to worry about it. We're not concerned about it until, these ripples we may be monitoring and watching. But in general, a great example, the momentum crash of February and March, which, I'll kind of enlighten it more too of what some improvements we've made because of that, which I think you and I were together in Savannah
Yeah.
during that period,
Yep.
getting to watch some of those stocks drop 50% in 2 weeks. I think you had Carvana, Sprouts Farmers Market, the Robinhood, Palantir, all of them. This is
Right.
significant moves. And in most cases, no similarities to their businesses other than high momentum, right? So a lot of that correlation happened there. But you can see within the system, again, going back to that kind of relative movement, Palantir actually didn't move in our system. So we didn't have to be concerned or do anything with the stock because it stayed steady through that period. Until recently, this is another reason I gave this example because we had to actually, when it hit that red line, one of our system indicators would say we have to sell it and move on. So we'll monitor it if it comes back different, we can get back into it. But for the time being, we're removed from Palantir. So
Right. So its rank fell far enough relatively to be this isn't where we need to be anymore.
correct. Yeah. So it's not we're not allowed to be in a less than top 25% of the market. So we can get into that
fantastic.
top 25%, but we can't be outside of it. So
Gotcha.
and that's
Gotcha.
a good thing. Another stock we wrote about was Spotify. Spotify a few months ago fell out of that as well, and we had to get out of it.
Oh, wow.
Hindsight, it's great. We're glad we did.
Yeah.
But it was something that we just follow the
Sure.
system on that, which I love Spotify. I'm a user, but that doesn't matter. It's system said we had to get out.
Exactly. Yeah.
But this is a new addition to the fund,
Okay.
Ross Summers, as well. But the reason why I wanted to show you this is we also strive to find ranks that are more stable. So if we can rely on the ranking, we prefer those securities. If we can't, then it's not going to be a good position for us, which I just grabbed a random therapeutics company to give you an example of how chaotic a stock could be within our system. This isn't helpful to us, right? If we have to buy it and then sell it right away, it's not a good position for us. And so we try to actively avoid these. The only reason we would add something like this is if it gave us some type of risk mitigation factor that we wanted, or some other diversification that we needed to, and there wasn't another option in there. But in general, we're avoiding this kind of chaos in the system for the portfolio.
Nice.
Okay.
Okay.
Another thing we talk
nice.
about
Yeah.
a lot is the sectors. And so we do monitor sectors. We are able to overweight, underweight various sectors to not make the screen so chaotic. I just got the top three for you currently, and then the bottom three. So we've got the energy, materials as well, and as well as utilities. And then on the bottom, we've got consumer discretionary and staples, as well as communication services.
Yeah.
So one thing to point out is the gap between these. And so let's pretend these were the only 6 sectors. We could argue we know with some reliability we're going to be overweight these 3 relative to the bottom 3. And so we monitor those as well. It gets more difficult whenever it is very, very close combined clusters. But to help you visualize the understanding of the portfolio, this is a breakdown of the actual portfolio as of yesterday. And so this dotted red line is our the net negative. So if it's below it, it's a short. If it's above it, it's a long. That black line shows your net allocation to that sector. And so far left would be the energy sector, the best sector at the moment. Far right would be the worst sector, discretionary. And so you can kind of see our allocation over that.
Yeah.
If all the sectors were very close clustered to each other, the black net line would probably be pretty break even. We wouldn't be really overweight or underweight. And so you can imagine as if energy were to take a turn over the next 3 to 6 months, the energy is going to start moving through this. It may sound more complicated, but in conceptually, if you think about if energy is starting to underperform, your system's probably going to be making you sell energy, and you're going to have a lot more energy shorts available to you. So it's kind of a natural progression that happens by default if we didn't even have this visualization to look at.
Mm.
But we do, try to make sure we're in line. It's more helpful for something like utilities. It's one of the smaller sectors in terms of opportunities to buy. And so in cases like that, we won't see as many utilities in the top, 25% or top 10%. And it may be a good sector to be in, but that's just because there's less opportunity. And so this chart kind of helps spot some of those for us.
Nice.
And then referencing back to the February, March momentum decline that we had as well. We had been experimenting and studying with clustering, which clustering, for your viewers that are unfamiliar with it, it's just a way to group things. Sectors is a type of clustering, but clustering is a statistical measure for us. So we are looking at specific behaviors within our system to group them into clusters. This chart, you could go to 100 clusters if you wanted. I did this visualization for you to help point out how we could break them down. So this is just saying, give me 10 breakdown clusters. This is our actual portfolio. So this is green is long, red is short. And now if we say, because of these, characteristics that we're looking for, we break them apart, we'll have, this first branch is most unlike these. And now we can break them apart again. These are unlike the rest, and then so on and so forth. And so this gives you a better diversification view of how do the stocks actually behave. All energy stocks don't behave the same. So we use some statistical measurements to help us with that. Pushing that theory further, on the far left would be kind of that cluster, and you push that through your portfolio. We could start looking at this as kind of risk contributions. What levels are providing the most risk to the portfolio that we look at? If we were to click this top right box and dive in deeper, we could see what positions are actually contributing to the risk of the portfolio. And so these kind of mechanics really help us avoid more of that momentum factor without having to say, well, we need to add value, because value is a different bias, and we don't want to add value. So instead of adding value, what other statistical measurements can we utilize in order to protect the portfolio and operate in a manner that's not contingent on specific factors like, well, we just got lucky because interest rates were high and they went low, or we got lucky because inflation, did this, or so on and so forth. And so we really try to leverage strategies that are built for any market environment, not just coincidental to, if we're all 200% long, and the markets are going up, we're going to look smart, right? Well, that's because the markets went up, and so we're trying to leverage things that help us really dial in, no matter what's happening tomorrow, what can we do to have a decent portfolio? So.
Yeah. And as you said, persistence, does also pay in this, especially if you find the things that are not whipping back and forth,
And that is the hardest job, to be honest. And that's what a lot of the risk contributions really help, because in general, your low ranking stocks are down. And so you need to find how to look at that in terms of, well, which low ranking stocks can help you diversify some of those high ranking stocks and really avoid some of that momentum fluctuation, which it'll just happen anyways. It's just a byproduct of momentum investing. But we're actively always, every single day, pursuing ways to help with that. And kind of like your mention of AI, so one of the things is you could see where this is eventually going to go to more systematic approaches, where if you have a set of rules, AI is going to be able to help us visualize and see, okay, AI, we give you 1% to move today. What is the 1% that is going to alleviate these problems the best today? We can do that. And then tomorrow, same thing. And you keep building that over time until it's a very systematic approach that's kind of taking our biases out of it and using some type of statistic for it.
For sure, for sure. So how many positions are you guys managing in this ETF?
We're allowed to go up to hundreds. We've got basically
Okay,
350-ish total, probably 200
that's a
long.
lot.
It
Okay,
it is a lot, and so our focus is never being more that we can have more than 2% if we need to. I think we can go up to 5, but we don't want to, right? Like if
yeah,
equal weight is going to probably have a higher correlation to us, but we're looking to be an equity fund, and
sure,
so being only 60% long, but still outperforming the S&P, like that's our goal, like to be able to do something like that. And
right,
so we really want to say it's not Nvidia that caused us to have a good 3 years. It's if we
sure,
only had 2% of that stock. So we want to look back in time and say, no matter what, we believe this is for any market environment. And I mean, if you're in finance, I mean, you've seen multiple, king managers that have
hmm,
dominated for a decade. Then the era changes. And if we go into a lost decade, S&P is not going to do well,
right,
and we need a strategy that's going to do well, and I think this year is a great example of our performance relative to a indice like the S&P, that kind of allows for no matter what's happening, we have a strategy that we believe we can be moving with the markets, or moving with the good part of the markets, I should
yeah,
say.
yeah, absolutely. And something is always moving, right? I mean, even with most of the market down, was it energy and utilities? There were things that were doing all right. They
Oh,
weren't as super
absolutely.
obvious. So
Absolutely. It's even, S&P is not a good benchmark for that decomposition, but if you
sure,
look at like a Russell 3000,
mm,
it's very investable stocks, a good 5% of those every year are up more
mhm,
than 100%. I mean, that's 120 something stocks every year. They're not the same ones every year,
right,
but there is opportunity there in terms of massive diversification. And to me, that's what's exciting. How can we find that group of stocks to be long them, and
mhm,
then also short, on the flip side, that 5%, there's 5% of them that are down 50% or more. That type of return divergence doesn't exist in the S&P 500, but it exists in stocks in general, and that's an investable universe. Those are
yeah.
very liquid stocks. There are some, a couple hundred million market cap ones in there, but in general, it's investable. So.
Right, right. And I like a system like this, you're not stuck on your high conviction ideas that were good 2 years ago. And I've seen a lot of people do that. Like, well, tech is always good, right? Well, no. Eventually it'll
Yeah. Oh,
shift.
absolutely.
You're not totally committed to your ideas. Like this will allow you to be like, oh, open to new opportunities daily because they change.
Absolutely. Absolutely. And we have to be cautious. Software, I think, is a great
Yeah,
example of we have very little longs to be able
right.
to get in there. And
Yeah,
so we could theoretically short a huge trove of software companies, but I
yeah,
think we're still net negative 3%, that's a
yeah.
lot for us. We don't want to have too big of a pocket of exposure where if something happens, market changes its mind, starts rallying hard. We don't want it to hit us. So.
Right, right. And I think your Palantir example is perfect for that. Like something high flyer, it's not anymore. Not
Oh,
they're
and
they're
I
up.
so I did write a opinion deal about it as well, kind of contrasting to value that,
Uh-huh.
after the 1,800% return it made, what value investor, given the financials 2 years ago from the future, what professional would still invest in it? Most of them wouldn't. And it's like there's more to the markets in that way. And so we're just trying to be extremely systematic about it.
No, I love it. It's a great approach, and I love seeing how people use technology to make it happen. I mean, that's really
Oh
really
yeah.
cool.
Well, when I first built this 10 years ago,
Yeah,
my data scientist today laughs, looking at that system.
yeah,
Compute what we compute now would have taken over 5 years.
mhm,
And we compute it every day and
right.
and so it wasn't even possible. And so and that side's just going to get better and better and
Yeah,
better. So
for sure. For those who are taking advantage of it. So,
absolutely. Yeah,
uh,
yeah.
so
Right.
yeah, go ahead. As we wrap this up here, no, do you have a favorite investment quote that drives your work or your life or your opinions or
Oh, gosh. Man, there's so many managers I listen to and follow as well. Howard Marks is one. I feel like he's got
yeah, yeah.
thousands of them. One of the best distressed debt investors.
Mhm.
Gosh, caught me on the spot. I should have had that ready for you.
It was in the list. It's all good.
I
It's all
know,
good.
I know, I know. That's my
It's all good. Got to throw it out there. All right. No answer. No worries. No worries. And then, of course, I don't think you're going to be. We've got our Name Uncommon Knowledge conference coming up April 26th to 29th in Tampa, Florida. I know we saw you in California last year, but I think you're out this year. So
Yes, not this year, but hopefully next. So,
hopefully to see you again soon. It's just a lot of fun. It's always good to see you in person and talk to you. I always get a lot out of chatting with you. So like when we met in Savannah, that was just a good time and getting to know you. So definitely highly recommend getting to know Sam. He does some great work. The fun is awesome. We actually own a little bit of it, I'm going to admit. So big fan. So that's it for Name Confidential. Thanks for everybody for being here today, and we'll see you all next